Hello, my dear aspirants. Welcome back to our channel. So, today let us learn the difference between the equity investment versus mutual fund investment. So, what do you mean by equity investment? Equity investment is buying shares directly from the companies or other individual investors with the expectation of earning dividends or reselling the same when it is profitable. Just like how we buy the stocks directly from the stock market with the help of a broker in our day to day life. So, now we'll see what is mutual fund investment. Mutual fund is a pool of money managed by a professional fund manager. It is a trust that collects money from number of investors who share a common investment objective and invest the same in either equities, bonds, or money market instruments or any other securities. So the income or the gain generated from this collective investment is distributed proportionally among the investors. And that is what is called as net asset value. Simply to put on, the money pooled by in large number of investors is what makes up a mutual fund. To learn it in a simple way, let us take an example. Let's say there is a box of 12 chocolates costing 40 rupees, and four friends decide to buy this, but they do not have 40 rupees each. So, what they try to do, they pool from all these four friends 10 rupees each so that it becomes 40, and they can buy the entire box of 12 chocolates and distribute equally, that is, 3 chocolates or 3 units. And this is exactly how the mutual fund also works. So let us learn one by one basically how this mutual fund versus stock, which is better. There are five aspects we are discussing in this video. That is the professional management, how we save the tax on mutual fund, how we do disciplined investment, cost of investing, and investment horizon. Beginning with professional management. Leveraging the expertise and the knowledge of a mutual fund expert too is one of the primary reasons why individuals should consider investing in mutual fund. Since these mutual fund experts have the knowledge and ability to bear the risk and be in the safer zone to provide the returns, it's better to go with a mutual fund. Investment in shares with without the prior experience or knowledge about working of the financial market can be quite distress. If you do not have proper experience and the knowledge of the finance market, or you do not have a proper time, so this could not be so favorable. It could even easily drain out the capital from an individual. Hence, experts often advise those who are new to the market it's better to invest in the mutual fund through a fund manager. There's also a thing like you can save tax on mutual fund. When it comes to equity linked saving scheme, that is ELSS mutual fund, when you invest this in this, Section 80C of the income tax offers the deduction of investment up to 1.5 lakh towards such schemes. Individual and HU can use this deduction to reduce the tax liabilities, so far calculated as 46,800 by investing 1.5 lakh in ELSS mutual funds. This is one way you can save tax on mutual investments. Now we'll see what is this disciplined investment. Another major advantage of investing in mutual fund is that it allows us to invest in SIP. SIP is nothing but systematic investment plan. In an SIP, investor is required to invest a fixed amount periodically. That period may be selected by an individual either monthly, quarterly, 6 months, or lump sum yearly. This automated form of investing in a mutual fund requires an individual to decide the quantum of a payment and the frequency of investment at the start of the SIP investment tenure. On the other hand, investing in stock this way can be quite tricky as each transaction would need to be timed and initiated by investor himself. That you have to remind yourself to invest monthly, which is not automated. You have to be very disciplined in your investments. So in this way it goes. Next, cost of investing. Unlike stocks, which you can buy individually, actively managed mutual funds demand a small fee, that is in the form of brokerage or commission, to the fund managers. However, one often forgets the concept of economies of scale that tips their weight in favor of mutual funds. Active management of the fund surely requires extra capital from the investor's pocket. But due to their large size, mutual funds only ask an insignificant fraction of a brokerage from an individual. What I would suggest, if you do not have proper time or proper knowledge about the market, it's better to invest in this mutual fund. But one who have time to understand and analyze the market and one who willing to take the risk, it's better to go with the stock market. Investment horizon since mutual fund often requires a tenure of 5 to 7 years or even more to generate a considerable returns. But I can surely tell mutual fund generally earns more than the FD returns, and which is quite obvious that it beats the inflation also. This is because these investment vehicles have a long term growth. On the other hand, investing in stock can fetch you quickly and substantial return. Like you can invest anytime, you can come out and sell it anytime. So, on the whole, which is better? Whether you decide to invest in mutual funds or stocks entirely depends on your knowledge and expertise of the market and the amount of a time and effort and the risk you are willing to spare. Mutual funds can prove to be a great investment in instruments if you are an amateur and aim to for a steady returns. However, if you are a stock market guru with ample time on your hands, investing in stocks is better. There are some more differences for mutual fund versus equities, like it bears higher risk. Equities are like higher risk. Mutual funds go with a lower risk, and there is very limited diversification and mutual fund have a broad and instant diversification as the amount is pooled from lot of individual. They have lot of money to invest in different stocks also. So potential for high return is more in case of equities because the higher is risk and return is obviously high. In case of mutual funds, there is a moderate return with a lower risk. There are some more other differences. I can go through this. Do like and subscribe for further videos. Stay connected. Thank you.